Welcome, everybody, to today's webinar. I'm Ryan Monette, financial advisor and team leader in the Rockford, Illinois Savannah office. And with me is Scott Laue, financial advisor, also out of the Rockford office.
Thanks, Ryan. Pleased to be with you today. I joined Savant, interestingly enough, at the very beginning of the financial crisis way back in 2008. And then, Ryan, as I indicated, I work alongside you in the Rockford office. And, I think back over the last 32, 33 years that I've been helping individuals and participants in retirement plans. And I think back, and probably their second biggest concern is related to Social Security. When should I collect? What sort of claiming strategies are available? Is there going to be enough money there for me? So clearly, I think today our topic is very timely, and at times it can seem very simple and other times kind of complex, but look forward to presenting with you today and helping provide some clarity.
Thanks, Scott. Over the last 13 years, now 16 of them being with Savant, but over the last 13, I've really taken a liking in Social Security. I remember working back in our financial planning department, and not a lot of folks had just a great amount of knowledge of Social Security. So I started reading. And after years and years of reading the trustees' reports, I think I'm finally ready today to talk about this important topic. So we're pleased today for the opportunity to share thoughts on a critical lifetime income stream component enjoyed by almost 71 million individuals. And that, of course, is Social Security. At times, it can seem very easy to understand, and other times it can be quite confusing. Our goal today is to keep our compliance staff happy, as our intentions today are strictly informational. So now that you know this presentation is intended for informational purposes only, we can begin. All right, so today we're going to begin by discussing several of the most important mechanics of the Social Security system. We'll then review the various factors that individuals should consider before filing for Social Security benefits. We will review how to weave Social Security into an optimized, comprehensive retirement income strategy. And finally, we'll wrap up with an action plan and your questions. And with that, I'll hand it over to Scott to discuss how the system works.
All right. Great. Thank you, Ryan. So a little background, the Social Security Administration was actually created way back in August of 1935 when President Roosevelt signed into law the Social Security Act. And remember, Social Security was never designed to fully fund one's retirement, but Ryan, as you indicated, it provides an important source of income to almost 71 million retirees, folks who are claiming under the disability rules, as well as surviving spouses. And what's very interesting is when they were debating what would be the first claiming age way back in 1935, there was great debate whether or not that should be age 65 or even age 70. Well, they decided on age 65, but had that changed a little bit, we probably wouldn't be quite having the solvency issues that maybe we have today. So with that, let's chat about really, that big elephant in the room. And that, of course, is, what's the longevity of the Social Security Trust Fund? And technically, the system is underfunded. So at some point, we will very likely see some reforms and changes in the future. Now, part of that reason why, of course, is people are living longer. There are people that are claiming at an earlier age. When we go through recessionary periods of time, the revenues that are being paid in through the payroll taxes are less. People are having higher costs. So there have been some challenges, of course, on the revenue side. And frankly, the trust fund is expected to be exhausted, believe it or not, by 2034. And it's at that point when only 78% of the expected benefits will be able to be paid out. Now, the good news is there's lots of different levers that can be tweaked to help move the needle along the way. And just like most things in life, you can either increase the revenue, increasing the income through taxes, or potentially reducing the benefits, which of course is a political hot potato. So on the revenue side, one strategy is to increase what's called the payroll tax rate. So currently, we all pay 6.2% out of your wages, comes out of your paycheck and flows into the Social Security Administration. And remember, too, that the employer also matches that amount. So there's a total of 12.4% of your wages that's being sent to the system on a regular basis. So one proposal, of course, would be, well, let's increase that tax rate from 6.2% to something higher. Now, the challenge, however, is that would be paid by every working American. Now, another strategy that's being bantered about would be to increase what's called the taxable wage base. So there is a dollar amount on which you pay that 12.4%, 6.2 that comes out of your paycheck, 6.2 that the employer kicks in for you. And currently that taxable wage base is right around $160,000. Just last week, it was announced, because it is indexed for inflation, that that amount is going to jump to $168,000 for next year. So said differently, any earnings over that amount, you do not pay any Social Security tax on. So there are proposals to treat it like your Medicare tax that you pay on all dollars that you earn. That, of course, would impact, again, every working American. There's also some proposals out there that would suggest, let's cap it at that $168,000. And then there'll be a gap. But then for those higher income earners, current administration defines those folks as making over $400,000 annually. Then that Social Security tax might kick in again at that point in time. But remember, too, that it's not just the employee paying in, the employer has to match that, which means the employer will have higher costs. They figure out a pretty good way to pass that on to the consumers. So think inflation potentially going down the road. Now, on the benefit reduction side, okay, this is that political third rail. No one wants to touch it. But there are some proposals that would suggest raising the full retirement age from age 67 for anyone born in 1960 or after. And Ryan will share in a little bit what your full retirement age is based on your year of birth. But there's some proposal that would say, you know what, let's raise that age from 67 to 68, 69, or maybe even 70. That, of course, would put less stress on the system. There's also talk about that delayed benefit age, currently 70, meaning you don't get any additional benefits if you wait to claim past 70. Well, maybe that age should be extended to 71, 72, or 73. So again, at some point, Congress will have some bipartisan legislation to help address some of these issues. Now, in addition, there is also a cost of living adjustment that could potentially be changed as well. Now, at the moment, the COLA is based on the Consumer Price Index. And the challenge there would be if there was any less of an increase, that would adversely impact many folks who, quite frankly, are on a fixed income, and that probably wouldn't buy too many votes going down the road. Now, for years, we've been hearing about the challenges on the Social Security side. The good news is the system will be around. It will endure. It might look a little different at some point moving forward, but it's always important to make sure that you're basing your claiming strategies, your claiming decisions on what we actually know, not what you think might happen or predicting or speculating for something coming down the road. All right, so on this slide, I want to share with you a little bit, well, how are the actual benefits calculated? So a couple of numbers to keep in mind. You can see in the upper left-hand part of the slide, 40 credits required. So what does that mean? You have to be eligible to start claiming Social Security, you need to earn 40 credits. So how do you earn a credit? So currently, every quarter that you work, and if you make over, and it is indexed for inflation, if you make over approximately $1,640, congratulations, you earn a credit. So again, to be eligible, you must earn at least 40 credits or you have worked for a period of 10 years. Now, they don't have to be consecutive 10 years, but just over your working career. Now, what's also interesting is that the number of credits that you actually earn does not determine the amount of your Social Security check. It's just whether or not you qualify or not. And sometimes we get the question, well, what happens if I don't have or I haven't earned those 40 credits? Well, again, that's what you need to qualify. Now, for folks who are married, and Ryan will get into this strategy in a little bit, if you're married to somebody who does qualify and you don't on your own record, you can then elect some spousal benefits that would be equal to 50% of your spouse's benefit at their full retirement age. All right, that middle block, 35 highest years. So your Social Security benefit ultimately based on how much money you earn over your 35 highest income working years. So for most folks, the later years when they're working, of course, they're going to make more money then. So way back when you're scooping ice cream and flipping hamburgers, those lower income years will fall off. The Social Security Administration does take and index your past wages for inflation to help ensure that the benefits reflect the rise in the standard of living. All right, what's this average index monthly earnings and PIA and AMIE all about? So the Social Security Administration uses a rather complex formula, a little beyond the scope of our discussion today, to determine the actual amount of money that you would receive at your full retirement age. So again, it's based on those average index monthly earnings, and it looks at your past earnings history, taking inflation into account. It's divided by the number of months in the years beginning that's used in the calculation. And voila, that spits out a number that's called PIA, that primary insurance amount. That's the amount when you go and you look at your Social Security statement, that's the dollar amount that you will receive at your full retirement age. Now, the good news is you don't have to memorize how that formula works. The Social Security Administration does that for you. Now, to share a couple figures that you might find of interest, the maximum Social Security benefits, if you've reached full retirement age this year, is $3,627. If you claim early at the age of 62, the maximum that you're going to receive is $2,572 a month. And Ryan will share with you what those steps look like and how much your benefit would be reduced if you choose to claim at an earlier age than your full retirement age. On the other end of the spectrum, if you delay benefits until age 70, the maximum Social Security benefits that any one individual would receive is $4,555 a month, or roughly $54,600 on an annual basis. Now, the average Social Security monthly check, if you want to know how you stack up against the rest of the world, that average amount is $1,827. Now, remember too, I mentioned earlier that there are these cost of living increases that might come into play as well. So let's take a look at some historical figures. All right, so you can see in the upper left-hand corner that these COLAs actually started in 1975. And prior to that, Congress decided what the potential annual increase would be. All right, if you look in the lower right-hand corner, the good news is last Thursday, it was just announced that recipients will receive a 3.2% increase, which will be effective, of course, with the first check you receive starting after January 1st, 2024. And when you take a little look at these COLA amounts, it's interesting that, over the past 15 years, we've only seen these COLAs be above 3% only 4 times. And of course, what we all remember is the big jump last year, 8.7% increase, which was the highest amount going all the way back to 1981. Now, what's also interesting is that we've had some years, 2009, 2010, 2015, that you'll notice where the increase was 0. All right, when we take a look at the mathematical average, kind of to see where this year, 3.2% effective next year stacks up, if you take a look at the mathematical average, looking at all those years going back to 1975, the average is about 3.8%. All right, a couple other items to keep in mind as you consider different claiming strategies for you. There's this earnings test rule, and we get a fair amount of questions related to this. So let me provide a little clarification. If you're still working and you choose to claim prior to your full retirement age, your benefits are going to be reduced. And after you earn $21,000, roughly $21,000, your benefits are reduced $1 for every $2 that you earn over that $21,000 figure. Now, the rules are a little different the year you reach full retirement age. So in that year, any earnings above $56,000 is reduced by $1 for every $3 that you earn above and over that amount. Now, the good news is once you reach full retirement age, and again, that's different for everyone based on the year you were born. Once you reach full retirement age, you can work as much as you want. Your benefits won't be reduced. Now, if your benefits do get reduced, interestingly enough, when you go to then claim at a later point in time, the Social Security Administration will recalculate that benefit amount. So you'll eventually get credit for those months that were reduced while you were collecting but still working. All right, governmental pension offset and the windfall elimination provisions. Okay, certain individuals might have a reduction in the benefits that they receive from Social Security because of past work in which they did not pay Social Security taxes. So think teachers, typically they don't pay into Social Security. Think government employees, they typically don't pay into Social Security. And the reason why is because they typically receive a pension. Now, when an individual works and does pay into Social Security, and then maybe they had a career where they didn't pay into Social Security, that's where that windfall elimination provision might apply. Now, both of the calculations are fairly complex and a little, again, beyond the scope of our presentation today, but we wanted to remind you or be aware that that might apply to your situation. If that does indeed impact you, Ryan and we can be available offline to help provide some thoughts and perspective and answer your specific questions. All right, what about taxation? Well, believe it or not, your Social Security benefits may be taxable depending on your other income. Now, that might not sound fair because you paid into the system, monies came out of your paycheck, you then claim, you get your own money back, and I've got to include it in income and pay tax on it. Aren't you taxing me twice? And the answer is yes. Now, depending on your other income, the amount of your Social Security benefits that you'll have to include in income will either be 0%, that's good, or 50%, or 85%. To determine which tier you fall in, there is a definition called provisional income. And basically, if your provisional income is over $44,000 for married filing joint folks, congratulations, you're including 85% of your Social Security benefits in income and paying ordinary income tax on those amounts. Now, Social Security does allow you to have monies withheld from your Social Security to help soften the blow come the following April 15th. There's 5 different withholding amounts that you can choose from. You can pick 0, you can pick 7, you can pick 10, you can pick 12%, or the maximum that they will deduct is 22%. All right, what about this coordination with Medicare? Because sometimes a lot of people think, well, if I'm on Medicare, I also need to be collecting Social Security, and not necessarily the case. So Medicare, remember, kicks in at what? Age 65. You can claim Social Security prior to Medicare age 65, or you could claim after age 65. And again, Ryan's going to go through some of the strategies that you might consider. If you do claim Social Security after you're enrolled in Medicare, in order to pay those premiums, you will then instruct Medicare to debit your bank account and automatically pay those premiums that way. Once you're collecting Social Security benefits, the Medicare premiums will come out automatically out of your monthly check. So with that background, I'll pass the baton over to Ryan to talk about some claiming strategies.
Thanks for the overview, Scott. That's really helpful given there are so many moving pieces and complex rules with Social Security. And I'm glad that you emphasize that we need to focus on what we know and can control rather than making a hasty decision based on what we expect. While changes are likely, I don't think Social Security is going away. So let's not make those hasty decisions just yet about claiming. This will be a nice segue into our next topic, which is claiming strategies. But before we get to that, I do want to address something that you and I have worked on quite a bit in the past, having to do with these advanced claiming strategies that are no longer available. In 2015, the Bipartisan Budget Act was passed, which updated some rules on claiming. These updates were designed to eliminate so-called aggressive claiming strategies and help reduce deficits in the system. So some of these techniques you may have heard of, and they might sound really familiar, such as file and suspend or file a restricted application for spousal benefits only. If you're watching today, you're probably wondering, well, how come we're not going to talk about that? And the answer is there's only about 3 months left for certain individuals that have access to those strategies. If you were born after 1953, those are no longer an option for you. So those of you that are currently age 69, you still have these few months, but the benefits at this point received would be immaterial. Social Security imposed new deemed filing rules, which basically state that if you apply for a benefit, you are deemed to be filing for all available benefits and can therefore not take one benefit now and the other one later. An important distinction here is that survivor benefits were not impacted by this deemed filing rule. So there are still a number of advantageous claiming strategies if you're entitled to survivor benefits or ex-survivor benefits. Please send me a note if you are in that situation, and we can have a whole suite of educational content available on survivor benefits. All right, so when we think about, as financial planners, when we think about claiming strategies, we like to start by thinking about the goal before we think about the tactics and the strategies. We want to know, what are we trying to solve for and what are we trying to accomplish? You might ask, well, is it quite simple these days if those aggressive claiming strategies are no longer available? Is it simply you claim at 62, 63, 64, 65, and keep going all the way to age 70? Or is there something more you can do? And I'll be honest, it is sometimes that simple. But we also need to incorporate the goals, the financial plan, advanced planning strategies. So we'll talk a little bit about that now. Question that you want to ask yourself, if you haven't claimed yet, am I trying to maximize the total amount of benefits that I'll receive over my lifetime? That sounds logical, but there's typically a trade-off because you need to defer benefits in order to maximize them. So it's important to start by taking a long-term mindset and think about your total lifetime benefits, not just what you could get next year. Expected longevity also plays a big role in your claiming decision. I've heard many people say, I might not live that long, so I want to take the benefits now. I'm sure Scott has heard that countless times too. While there might be a few people that know they have a very short time horizon, the fact is that most people still have a lot of time ahead of them and can't possibly know. So we've got to work through that uncertainty on longevity and think more about the goals themselves. One of the most common goals people have is to enjoy a sustainable retirement cash flow and not run out of money. If you're in that group and that's a goal of yours, we should be much more worried about living a long time versus living a short time. Your claiming strategy should primarily be to protect against a longer than expected life. If you do live a very long time and end up depleting your nest egg, it's important to have the largest possible Social Security benefit as a safety net to help manage that longevity risk. If your lifespan ends up being shorter than expected, depleting your nest egg isn't much of a risk. Lastly, it's important to think about potential spousal and survivor benefits if you are married. You need to shift the focus from just your lifetime of total benefits earned to the total lifetime benefits as a couple. It's not just a single life expectancy we need to think about, but the combined life expectancy of both of you. The most common application of this is when we have the higher earning spouse of the couple defer until age 70 to maximize their own benefit and also maximize the amount of potential survivor benefits available to their spouse as well. But for those looking to maximize income in the short term, there may be a couple strategies available for you too. If an individual claims Social Security before their full retirement age, they will have 12-month period of time to decide whether they would like to continue those benefits or not. And if they decide not to continue, they will need to pay back the entire amount received though. Doing so treats the future Social Security benefits as if they never took that benefit at an earlier start age at all. Another strategy exists after an individual meets their full retirement age. It's at that point or later that an individual can elect to voluntarily suspend their Social Security benefit and allow it to start earning delayed retirement credits. In a way, they can start the benefit back up afterwards when they're ready. All right. So starting with the goal in mind when thinking about when to claim Social Security is a good place to start. It is also important to look at the quantitative data though. The simplest way to do that is to think about break-even ages. Keep in mind that according to the IRS and Social Security life expectancy tables, a 62-year-old today is expected to live until age 86. This chart on the screen that you're looking at now shows us the cumulative lifetime benefits of 3 claiming strategies: claiming at 62, claiming at age 66, and claiming at age 70. And we can examine where those lines cross over. If you knew exactly how long you were going to live, this would be the chart you'd reference to pick the optimal claiming strategy. You may have seen different versions of this online as well. An age 70 claiming strategy typically wins out if you make it to about age 80 or 81. So if you do live to that average age of 86 or beyond, deferring until 70 is a clear choice. A common tool we use to analyze lifetime cumulative benefits is our Social Security analysis, which helps determine the total benefit you may receive based on the age benefit start and different life expectancies. And of course, any of your claiming decisions will impact other areas of your financial life. So all of the information that we mentioned thus far is referencing the individual worker that pays Social Security taxes. However, there are benefits available to spouses, divorced spouses, and survivors as well. A simple way in which benefits can increase or decrease is based on the age in which an individual claims them. Scott alluded to me talking a little bit about those reductions later on in the presentation, so we're at that point now. Individuals claiming on their own benefit can claim as early as age 62 or as late as age 70. Claiming earlier will have a permanent reduction in benefit, while claiming after your full retirement age will have a permanent increase in benefit. The chart that you're seeing on the screen now shows several pieces of information that you'd want to take into account when thinking about your own claiming strategy. On the far left side, you have a year of birth followed by the full retirement age. From there, we look at the number of months benefits would be reduced if you claim Social Security benefits as early as age 62. Assuming a primary insurance amount of $1,000, you can see the reduction in dollars and percentages if an individual were to claim at age 62 based on their age. For example, an individual with a full retirement age of 67 would receive a 30% reduction in benefits if they decided to claim at the age of 62. Subsequently, a spouse that will rely on a spousal benefit would receive a 35% reduction in the amount they could receive if they claim spousal benefits at their age 62. Moving forward, integrating Social Security benefits into your retirement income strategy is an important step in the financial plan. In a sense, Social Security is like a big bond in that it will produce consistent, known fixed income. It can be an important source of income for individuals' ability to meet their future spending goals. One of our primary responsibilities is to determine cash flow strategy for our clients during partial or full retirement. Here are some tools and strategies that we'll consider next. Working through a Social Security claiming strategy is an important part of an individual's or a married couple's financial plan. Using a comprehensive tool that incorporates your spending goals with your resources is crucial to helping you choose a claiming strategy that will help you maximize the funding of your retirement goals. A retirement planning tool like the one we use, Money Guide Pro, provides a big picture overview of the various Social Security claiming strategies available and the impact on your financial plan. The chart that you see on the screen shows how we can incorporate the financial resources and spending of a household, keeping all inputs and assumptions the same, and only adjust when and how Social Security benefits are claimed. We can then focus on the probability of success to determine which strategy will produce the strongest results. The illustration on the screen now, you can see the title at the top of the chart showing the age at which someone will claim their Social Security benefits. So on the far left side, it says strategy used in scenario. Next to that, as soon as possible. Number 3, at retirement. Number 4, at full retirement age. Number 5, at age 70. And what you can do is, looking down from the title of each of those different slides there, is you can look down and you can see a probability of success percentage as well as total lifetime benefits. So when we run this type of analysis, we can really show them over their life expectancy, again, keeping all of their assumptions and inputs the same, when would it potentially be the best time to claim Social Security, and what strategy? When should one spouse claim? When should the next claim? We can change those ages up. We can also change the life expectancy to get perspective. If you have a shorter life, what's the best option to choose? If you have a longer life, what is the best option to choose for that strategy? When building out a retirement income strategy, we like to look at all sources available to meet spending needs. This can include retirement accounts like 401ks and IRAs, Roth IRAs, or brokerage accounts. We also include cash assets or other sources of fixed income like a pension, income from real estate, and part-time income. Accounting for all assets and income can help us design a cash flow strategy that allows us to model various Social Security claiming strategies. Claiming Social Security benefits early will allow for investable assets to continue to grow. This can be beneficial when an individual believes their assets can grow at a faster pace than the increases earned when delaying Social Security. Or for someone who perhaps has a shortened life expectancy and would prefer to make sure they leave a legacy for loved ones. Claiming Social Security later may allow for strategic planning opportunities like Roth conversions or selling an over-concentrated investment that will trigger significant tax implications. Using the chart on the screen, we can explain to a household where their resources will come from to meet their spending goals in any given year in the future. In this example, the household elects to delay claiming Social Security, the dark blue bars. They start by living from part-time income, the yellow bars, and distributions from their investment portfolio, the light blue bars. They start Social Security, and because of the delay in benefits, it nearly allows them to stop their distributions from their investment portfolio. So you can see designing an integrated retirement income strategy is a necessary step in the financial planning process, provides a ton of perspective for individuals to map out what the rest of their life could look like as far as their resources go. And Social Security, really, at the end of the day, is at the heart of the analysis. And now I'm going to flip it over to Scott. We have an action plan for everybody and some next steps.
Great. Thanks, Ryan. Really appreciate hearing that, how we go through that coordinated approach, and clearly a lot of value gets added when we take a look at that comprehensive perspective. So we've armed you with a lot of information so far. So the next critical step, of course, is, well, how do we put all of that into action? All right. So what should you do next? If you haven't already done so, log into ssa.gov, get your pencil out, ssa.gov, create your account, and review your benefit report. And it's always a good idea, at least on an annual basis, to review the earnings record to make sure that you're indeed getting credit for your wages that you're having your payroll tax come out of. You want to make sure that that's accurate, because remember, the benefit that you received is based on those 35 highest income years. Now, it's also important to take an inventory of the other benefits that might be available to you as well. Ryan hit on spousal benefits a little bit. We talked about ex-spousal benefits. We talked about survivor benefits or ex-survivor benefits. So if any of those apply to you, the Social Security website is a pretty good place to get some information. Then once you analyze all the options, determine what might be a good break-even age and claiming strategy for you, to consider, well, how might you maximize your lifetime benefits? And then at the end of the day, finally integrate Social Security into that comprehensive retirement strategy. And as Ryan indicated, weaving in taxes. When do Roth conversions make sense? What about the investments? And of course, considering any other income sources along the way as well. Your Savant financial advisor, of course, can help you sort through all of those important details. All right. We've mentioned a couple times during the course of our presentation today that we would love to potentially visit with you as it relates to talk about your individual situation. We'd love an introductory call to see how we can potentially help. So if you click on that link, we'll get you connected with a Savant advisor who can help guide you through your pre-retirement or your semi-retirement journey, and then ultimately help to determine if you're on track. So with that concludes the prepared comments we had with you today. We have over 800 people registered for this. So what we would like to do is move on to our question and answer. I already see quite a few questions that are being asked. We obviously won't get to all of them, but we will respond. If you do submit a question, we don't get to it today, we'll make sure that we circle back personally with you. So right. Ryan, how about I take the easy ones and you get the tough ones?
All right, I don't know about that, but I'll start off. I got the first one, and it is a little bit easier for me, but it's a question that we receive quite often, and that question is, what is deemed filing? So earlier in the presentation, you probably heard me say deemed filing, and I didn't give a ton of background behind that, but deemed filing came about under that 2015 Bipartisan Act, and it's always been around. Essentially what deemed filing means, though, at the heart is when you apply for benefits, you're applying for all of the benefits that you're eligible for, and you will receive the largest of what those benefits might be. The reason why that's important is before 2015 in the Bipartisan Act that was passed by Congress, individuals had the ability to do things like, I'm going to, file, but then not really claim my benefit so I can start getting a spousal benefit instead. And then later, when I'm done getting my spousal benefit, mine has grown, I'll go ahead and start mine back up. And so deemed filing now, what it's essentially done is it doesn't allow anyone to do those strategies. It essentially says, hey, when you go to file for benefits, we're going to look at your spouse's benefit, whether you get a divorced spouse benefit, a survivor benefit, and we're going to look at that. We're going to give you the largest of those. Now, I did mention earlier, too, that there is an exception to survivor benefits. There is a strategy that still exists that deemed filing does not apply to survivor benefits. And that's where an individual, for example, if their spouse passes away, they can actually claim a survivor benefit early and allow their benefit to continue to earn and grow, and then claim theirs later on. I have some personal experience with this, and it does work quite well. So that's a little bit more on deemed filing.
Ryan, a question has come in regarding the COLA increases. And the question is, with that Social Security COLA increase, 3.2%, as I mentioned, what impact does that have on my Medicare premiums? And this is really more specifically related more to Medicare, because just because your COLA for Social Security went up by 3.2% doesn't mean your Medicare premium increase is going to be 3.2%. And in fact, last weekend, they did just announce the new Medicare premiums, depending on which tier you fall in based on your income. And there was a 6% increase in your Medicare premium. So, here's a good example of, the government giveth by increasing your Social Security benefits. And on the other hand, the government taketh away.
Very good. Very good. And another question just came in. When will my delayed credits earned start? So those delayed credits, remember, when you hit your full retirement age, if you haven't started your Social Security benefit, you start to earn 2/3 of 1% per month, or approximately 8% per year. And so the question is when does that start? So for example, if you were to earn these delayed credits throughout several years. As soon as you turn on the benefit, you would think immediately that you start to earn that extra benefit amount. And that is somewhat true. But a good example would be, let's say that you are 68 years old, you've delayed for a couple of years now, and your birthday is in June. And so you've gone half the year earning another round of that 2/3 of 1% for the calendar year. You'll receive the first couple of years right away upon claiming. So let's say in July you claim, you can start getting the first 2 years, that 8% twice right away. But what you would earn for the first 6 months, that 2/3% of 1%, that actually you won't start until the following January. So that's a question that we get quite often. So that's how that works. Another question related, oh, sorry, Scott, another question related to cost of living adjustments and delayed retirement credits has to do you get both? Do you get a cost of living adjustment while you're not taking Social Security benefits? And the answer is yes. How that works is that a COLA, or cost of living adjustment, is first applied to your primary insurance amount. Okay, the amount that was determined is the full amount that you would get at your full retirement age. So that COLA is applied annually to that number. And then afterwards, they apply the delayed retirement credit adjustment to that amount.
So Ryan, maybe another good reason to potentially delay, if cash flow permits, until age 70.
Especially in maybe a high inflationary period.
Ryan, a question came in as it relates to Social Security, trust fund solvency, and how long the monies will last. And the question is, at one time there was consideration to invest Social Security trust funds into the financial markets. Will that ever happen? Under current law, the requirement is that the Social Security trust fund has to invest only in U.S. Treasury securities. Now, there have been proposals over the course of time, and there's another one, interestingly enough, that's in the proposal stage as well, that would actually form an entity that would borrow money from the U.S. Treasury and pay it back over a period of time. They would take those funds, invest in low-cost index funds. It would be professionally managed with professional oversight. Any earnings and growth would pay back the Treasury over this period of time, and any excess, if there is any, would flow to the Social Security Administration trust fund. Now, that's probably an oversimplistic explanation, but given the long-term nature of Social Security monies, because again, when we talk about investing monies for individuals, we really want to make sure that they don't run out of money. So the runway for Social Security is, quite frankly, indefinite, really long period of time, and probably some sort of a strategy like that at least ought to be considered. It would require, of course, bipartisan agreement. But again, everything's going to be on the table to help try to shore up those current trust fund monies and make sure that those benefits will continue for all who qualify.
Yeah, good explanation. Here's a question that you and I love, because this is really kind of getting into some real life examples right now. Here's the question. I'm still working, but my spouse is on Social Security. When can she switch to take spousal benefits against my Social Security? Okay, so, and this person wants to know because this person has been the higher wage earner for many years. And so the answer is that upon the working spouse that's still working filing for their own Social Security benefit, that's when a determination will be made for the spouse that was already claiming to determine if that spouse should get a larger amount. The Social Security Administration actually does that automatically. They'll know that one spouse is already claiming, and then when the other one goes to claim themselves, they'll know that, and they'll do that calculation. Now, I'm a big fan of what do they say? Trust but verify. So I'm a big fan of not just allowing that process to unfold by itself, but actually calling the Social Security Administration or walking in their door and setting an appointment and making sure that they know that there's an opportunity for a spouse to receive a larger amount. Now, whether the spouse will receive that bigger amount or not is really kind of based on, well, when did the spouse start claiming? Do they have a permanent reduction? But again, that's all calculated at the Social Security office. And it's something that, Scott, you and I have calculated.
Yep. And Ryan, I think that might be related to another question that I see here. Can you explain in more detail when and how a spouse can claim half of the other spouse's benefit? And I think you addressed that. So I think what that question is getting at, I might not qualify on my own record. Can I claim on my spouse's and claim that 50% of their benefit? But I think, and correct me, Ryan, doesn't that other spouse need to be at least full retirement age for the other spouse to collect up to 50% of that benefit?
Good question. So as long as the individual claiming is at their full retirement age, that's where they can get the 50%.
Okay.
Yeah. So in that example, for, you could, for example, let's just say that that I'm the higher earning spouse, I claim at 62, and my lower earning spouse hits their full retirement age. They can still access 50% of my primary insurance amount, even though my benefits reduced because I claimed early. If they wait till their full retirement age, it's still going to be based on my primary insurance amount. So hopefully that helps answer that question. Now, I have a question here. And this goes back to something that you mentioned during your part of the presentation, Scott. It asks, in the year I take Social Security benefits, or if I take them before Social Security benefits before my full retirement age, can I earn as much as I can that year and not have it affect my monthly benefit? And the answer is no. If you were to claim before the year you turn full retirement age, you can earn about $21,000 per year without having to give any back. In the year you turn your full retirement age, I think that number was somewhere in the 50s or 60,000 range that you can earn without giving any additional dollars back. But once you hit full retirement age and after, you can earn as much money as you want without any reduction in that benefit that you're receiving. And I think, Scott, you may have also mentioned that even though you might be working and taking Social Security at the same time, and let's just say it's being reduced because you're under that full retirement age and you're earning over those limits, the neat thing is that Social Security is going to take into account what you're earning because you're paying into Social Security, even though you're claiming at the same time. And those additional dollars that you're paying into the Social Security system, that's actually probably going to help boost your benefit. And they'll do that recalculation actually every single year.
All right. Well, thank you for that, Ryan. We're starting to bump up against our time, a lot of time frame here. We would like to leave all of you with a little Social Security trivia question for all of you to share at your cocktail parties this weekend. And that's related to, when Social Security first was created way back in 1935, as I mentioned, how long did the very first recipient of Social Security benefits receive those benefits for? So Ida Mae Fuller started collecting benefits at the age of 65, because remember back then that was the only age at which you could claim, and she lived to be 100 years old. Now, over the course of her working career, she paid in a total of $24.75 over a 3-year period of time. Her initial monthly check was $22.54. And over the course of her lifetime, she collected almost $22,900. So I guess the moral of the story is that, this Social Security system has been challenged going all the way back ever since day one. So with that, hopefully all of you picked up a few tidbits today, or maybe even confirmed some of your suspicions regarding Social Security. We appreciate your time today. And as I mentioned, if you're looking for more information, go to our website, www.savantwealth.com, to learn a little bit more about us and how we do things. Or again, if you'd like to click on that link and like a little free consultation, Ryan and I and the rest of Team Savant would be more than happy to chat with you. So again, we appreciate taking time out of your busy day, and thank you for joining us.
Scott, always a pleasure to present with you.